Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to episode 60 of the Capital Mind podcast. In today's episode, Deepak looks at recent SEBI circulars around brokerages and examines two big proposals. The first, which requires securities such as shares to be settled or show up in your account on a T+1 basis or the next day. And the second, which is a proposal where you no longer need to transfer money to your broker and then trade from that, but instead block the money in your bank account and send it to, say, the clearing corporation if and when you trade. In this episode, we discuss what happens when you click buy or sell, the evolution of where risk lies in the system over the years, the economics of brokerage firms, and some unintended consequences of these proposals. For example, how they might impact the number of traders and investors in India in the years to come. So do listen in. Hi Deepak. So SEBI came out with some very interesting proposals, I think just towards the end of January or maybe a little bit before that, where SEBI is already in many ways clearly a far more advanced regulator than at least the SEC. I mean, and that's the comparison that people draw constantly. But it introduced these new things which would make Indian markets, well, very different from, I guess, markets in the rest of the world and potentially much safer than they even are today. And I think most of us are reasonably happy with that. I think there were two big ones. So I'm going to start with the first one, which I think was covered quite extensively. And the rule is that currently, I believe, or up to this rule, you'd get some of your securities at a T+2, what settlement and so on. So you'd, I guess, buy today, but the shares would only show up in your demat account in 2 days or something like that. They've changed this now, and now everything will show up in T+1. As a sort of a half outsider on this, I guess what I would say is this sounds interesting and obviously makes things more efficient. But my question is this just the first step? I mean, why aren't we making it same day? Like I buy it today, I get it end of day. Or in the world of UPI and how all payments work, why can't it be instant? So yeah, that's my first question.
That's provocative, Shray. In fact, I think that is a very interesting case study to consider because at some point when you make a trade, you have to actually tell your broker, am I trading intraday or am I trading for a delivery trade? That means I actually intend to pay for this. Based on that, the broker allocates margin. He allows you to trade, say, 4x of the money you have for intraday, but only 1x the money you have for a delivery trade. So they already know. But the exchange doesn't know. For the exchange, it's like some broker is facilitating some client to buy and sell shares. It doesn't care whether it's intraday or not. To the broker, he's aware of this, that this person is doing an intraday trade. But for the exchange, there is essentially no indication. When the trade is squared off by the end of the day, the exchange says, oh, well, you know what, this trade is squared off, so it doesn't need to be settled. If it's left open, that means you bought 100 and maybe sold 20. The remaining 80 have to be settled. That means you have to pay the money and somebody who has sold you those 80 has to give you the shares and has to come to So this process takes T+2 in the sense that today, when you actually do this transaction of buy, you wait till the end of the day, the exchange figures out that your money has to be taken from you. It tells your broker, listen, Deepak, who is your customer, has bought 100 shares of X, so I need 5,000 rupees from him. The broker transfers the money from the broker's ledger to the exchange clearing corporation on T+1. The counterparty, who may be Shray, for instance, who has sold those 100 shares, his broker will take your shares, Shray, from your demat account and put it into the clearing corporation's account. On T+2, the world kind of flips this over and the clearing corporation gives your broker the money and my broker the shares, my broker gives it to my demat account. So this current process takes T+2. You could say, why isn't it, for instance, provocatively immediate? this is fabulous. This is a great idea. I think as soon as I say delivery, the shares, the minute you say you're selling and I'm buying, the money goes from my account straight to the clearing corporation using UPI. I can do that instantly. And the shares instantly transition from your demat account to mine because it's just electronic bits and bytes. Why should it take so much time in the first place? Great idea. However, one of the reasons why stock markets exist is that they provide liquidity. And when in the process of providing liquidity, it is clear that it may be that Deepak wants to buy shares, Shray wants to sell shares, but they may not come to the market at exactly the same time. So I may come in the morning at 9:30 a.m. You may only realize that you want to sell these shares at 11 a.m. If I'm trying to buy shares at 9:30 a.m., then who is on the other side if I need someone to actually own shares to be able to sell it to me? The answer is there are middlemen in the market, they're called jobbers, intraday traders, or whoever, who will say, listen, I don't intend to actually sell shares of X company to Deepak. I will just place the trade saying I am the seller and you're the buyer. And once you sell it, once the person says he has sold it to me, he doesn't have any shares to deliver. But what he does is he waits till 11 o'clock. Shray comes along. Shray is the one who's selling shares. He goes and buys them off of Shray. So effectively what's happened is he's cancelled his transaction, buy and sell transaction. Shray delivers the shares. Deepak gets the shares eventually. But the time differential has been made possible by the jobber or the intraday trader. Because such liquidity is very critical to markets. Typical markets trade say 40,000 crores a day, but actual delivery volumes are probably of the order of 20,000 crores. So roughly half the market is traded by people who just trade intraday between each other. It could be that this intermediate trader between 9:30 has bought it at 9:30, at 9:45 has sold it to somebody else. The somebody else has then taken that trade and sold it by 10 o'clock to somebody else. So it may have passed through a number of jobbers before it's reached an actual delivery transaction. So in some shares, you've seen even delivery volumes of the order of 20% and 25%, simply because there's so much jobbing happening in that stock. Therefore, I think immediate settlements are probably not desirable because liquidity won't exist. However, you then create a buffer now. You create a buffer, and the buffer is, in this case, the jobber. And you say, listen, let's do it at the end of the day. I think end of day every day is definitely possible. That means at 3:30 p.m. when the exchange shuts down, the exchange can say, listen, Deepak, you need to pay so much money. Shray, you need to deliver so many shares. By 5 o'clock, you should be able to deliver the shares because it's just electronic, and you deliver the shares to the counterparty exchange, which is the exchange clearing corporation. I deliver the money to the clearing corporation through my broker, and if the whole trade can be reversed almost immediately. That means that I receive the shares at 5 o'clock in the evening, and you receive the money at exactly 5 o'clock in the evening. Okay, so the next part of this transaction comes in saying, listen, now we're waiting for a full day. What happens? The reason why this T+2 was there was to allow checks to happen. So for instance, in the end of today, what would happen is my broker would get, Deepak, you need to pay 5,000 rupees. I haven't paid the 5,000 rupees yet. This trade used to happen on the exchange. He would come to me and take a check from me for 5,000 rupees, and next day morning deposit it in his bank account, because the checks would clear on immediately by T+1 evening. He would get the money on T+1 evening, and he would transfer that money to the exchange, and then the exchange would do the reverse settlement process. Now it doesn't happen like that. I pay in advance. I pay my broker in advance. So the broker already has the money. He can then transfer it immediately at 5 o'clock. The counterparty on the other side who has shares can also transfer the shares immediately. So T+2, I think, definitely is possible. However, there are some issues now.
T+0.
Sorry, not T+. Yeah. Immediate is not desirable. T+0 is possible. T+1 is currently where the new situation is. It hurts for the most part FPIs and FIs who have time differences in transfer, and they want to hold on to the money as long as possible before they actually do a transfer. So what happens at this point is who has the money. Like I told you earlier, it was checks. I used to have the money, I used to give a check, and then things happen. Now I transfer the money in advance to my broker. My broker holds the money. The money is then transferred to a clearing corporation, which then holds the money for another day. Who earns anything on this held money? It's a very large amount of money. And somebody who earns money on this in transfer process is the one that earns the maximum amount of what we call as float income. This currently is spread between the broker and the exchange. The exchange probably doesn't earn it directly through the counterparty. It may have arrangements with banks where banks might pay it for different reasons. But this is very large amount. I'm talking 30,000-40,000 crores per day on average will be sitting in the broker's account, which is why the biggest reason why HDFC Bank made so much money was it's one of the only brokers for the National Stock Exchange. Until everybody else realized that, my God, this is such a big float that everybody can earn money. Now there's Axis and there's SBI as well, who are also counterparty banks for the clearing corporation. So there may be more banks by now, but I'm just saying that, for the longest time, HDFC earned that money because it was the bank. It would have the money just overnight. But having 40,000 crores at 0%, or very little, was great for HDFC Bank. And it could then perhaps, pay NSE some part of that float that it earned, or as a fee, or as, a thank you note sort of for owning all of that stuff. This float money is something that also has a risk associated with it. Now, this is weird, okay, because let's say somebody in the middle has float. If that somebody in the middle has your money for that one day and he's supposed to pay someone else, and if he goes bust, you have a problem. Let me give you an extreme example. It's of payment gateways. A payment gateway, when you pay using something, the merchant gets the money on T+1 because they say, no, settlement period is T+.
It's generally worse than that, actually.
Yeah, it can be. But, one of the weird things over there is that the payment gateway actually carries the money over and holds it overnight for no reason at all. And the way they earn float from it is a weird mechanism. They may not directly earn interest from it. Maybe they do. I don't know if they do. But what they do is they go to the merchant and say, do you want money on the same day? I can't give it to you because it takes me T+1. But if you do want money on the same day, I can loan it to you. So I can send you the money on the same day, but I will charge you 1 day's interest. And that 1 day's interest, when you annualize it, can be 40% a year. But the merchant doesn't care. For him, it's the order of fractions of rupees because, for 100 rupees, it may be like, 2 paise or 10 paise. And he's thinking, I'll pay the 2 paise, 10 paise as long as I have the money on the same day.
Some incredible double dipping by the payment gateway.
Yes, and this happens. And because the payment gateway systems, whether it is, they call them payment gateways, or companies like, these people who say, I simplify UPI for you and so on. So those companies end up earning money with this overnight loan system, and this overnight loan system can earn them a significant amount of money. Now, why has this ever been created? If tomorrow RBI came and said, listen, if you get money on day 0, you have to transfer it to the merchant on day 0, this whole business is done. It's finished, right? So then they would have to figure out other ways to kind of earn money.
But there's an argument that they must be making is that if I batch it, I'm able to help with some, fraud checks, compliance checks and so on. Is that fair?
Well, I would say if they did that, yes, it would be a good thing. But I don't think at any point that in a UPI transactional system that you are able to detect a fraud when you have the money in your possession before you've actually paid it out to the merchant with that 1 day buffer, unless the merchant is not an established one. So, for instance, if your counterparty merchant is a very well-established merchant, somebody you've been doing business with for years, chances are the merchant has not frauded, or you have enough of a relationship with that merchant to say, listen, if there is a fraud, he will reverse the transaction. So let's say somebody uses a stolen card. The credit card company bears liability for it and forces some of that liability down the merchants as well. So if the merchant accepted, for instance, a stolen card, the transaction has to be reversed, and one of the two, either the credit card company or the other side of the merchant's bank, will bear the loss on this transaction. However, I think this buffer, this 1 day buffer, may not necessarily add a whole lot of fraud checks, but what it might, that's a good reason for them to do it if they were actually doing it, but that's not the reason why they do it. They do it to earn fraud. So, or to earn, the thing in the other way.
Fair.
So,
but coming back to stocks, and not payment gateways.
Yes. So now what is happening already is T+0. And if you look at T+0, that it's happening already, and why is it happening is the exchange said, listen, if you sell shares, and you want to pay on T+1. That means I don't want to pay you today, I want to pay you tomorrow. You have a system where you say that I have sold shares worth, 10 crores.
Yeah.
I will give you those shares by tomorrow. Now, if I'm a seller of shares, I'm assuming that's the end of the story. Because if I'm a buyer of shares, I have to put some money down.
Yeah.
I understand that. But the exchange says, I don't care if you're a buyer or a seller. I want 20% margin for whatever you have traded, debited from your account until you actually deliver those shares. So even if you're selling shares, you need to give me 20% of the value of those shares before you actually give me those shares. Now, to me as an end customer, I'm like, dude, I'm selling my shares. Why should I give you money to sell shares? I need money. That's why I'm selling shares. I can't give you more money. So what brokers did to offset this problem was something called an EPI, which is an early pay-in. The idea over here is, if I buy something today, instead of waiting till tomorrow to deliver the shares, I deliver the shares today itself. The broker takes the shares off my Demat account and transfers them at the end of the day, even today. So EPI is now followed by almost all retail brokers because they don't want this extra 20% margin to hit anybody. So this extra 20% margin, again, if you're buying shares, they say instead of putting only 20%, that's all the exchange needs for T+0, I will give 100% on T+0, so that the money is out of my account if I'm buying, the shares are out of my account if I'm selling. T+0, it's gone. It's just that the reversal trade hasn't yet happened, right? So what happens really is that because retail brokers anyway do this thing, now all of the shares and the money stay with the clearing corporation for a day. You've moved away from the risk of the broker. And you've said, listen, I'm giving the clearing corporation the buffer, which it retains for a day.
The clearing corporation doesn't particularly care about profits, nor is it a risk, right? I mean, in that sense, it's a kind of a boring government entry. Is that fair to say?
Yes. So, I would say at some point, yes. But remember that the futures and options transactions are cleared through the same clearing corporation as they are with shares. And so in the share market, there's probably very little risk. But think of the futures and options transaction. Let us say that I have sold a future of a company. And for some reason, the company overnight, it's trading at 20 rupees and it does something. And the next day, it goes and trades at 70 rupees. That's a 350% jump. Now, for a futures transaction, the clearing corporation demands, say, 20-25% margin. So for a trade worth 10 lakh rupees, I would have, the customer would have given it 2.5 lakh rupees. But now the customer has lost 350%. So he's lost 25 more lakhs, right? So he has lost a total of, say, 25 lakhs. But the margin he has provided to the counterparty, which is the clearing corporation, is only 2.5 lakhs. He has lost 10x. The customer can vanish. What does the clearing corporation say? It goes to the broker and says, listen, I don't care about which customer you have. I am taking whatever margin you've given me and I'm going to debit 25 lakhs out of that. And you could have given it to me on behalf of 100 brokers. I don't care. This is gone. You go and recover it from your individual customer however best you can. Now, the brokers therefore are liable in this way and in a way that clears the counterparty risk for the clearing corporation itself. However, what if a lot of stocks do the same thing in the futures and options market and the broker himself is not able to give enough margin to cover it? Broker goes bust. Now, clearing corporation has this problem. So the clearing corporation has certain buffers and usually there's like an investor protection fund of sorts that all brokers have to pay into the exchange to maintain. That means if brokers go bust, this fund is used to repay whatever the broker does not have as margin. The issue with this is this investor protection fund is roughly of the order of 6,000 crores, 7,000 crores at the NSE. And the NSE's exposure to the futures market is roughly 200,000 to 300,000 crores. This essentially means you have a system, like imagine a bank which has only 6,000 crores of capital that has lent out money of 200,000 crores. Now, you could argue that, yes, a bank has deposits and that's what it's using to lend in the first place. Same way, brokers have margins placed from various other brokers. I mean, brokers place margins with the counterparty central clearing corporation of the exchange. The clearing corporation has these margins from a lot of brokers and therefore it has the ability to face a loss. That's true, but that's like a deposit. It's a liability that you have to pay back anyways. So any one transaction, if any one broker is responsible for a 3% loss, that means that whatever that broker's exposure loses 6,000 crores, the exchange is finished, right? In the sense the counterparty is finished. So you end up with this risk sitting at the counterparty level at the clearing corporation itself. In fact, the idea of this is that even when you do a transaction, if you're a bank, you have to adjust your liability and assets of whatever you own against the risk assessment of the clearing corporation of the exchange as a counterparty, saying, listen, there is a small risk, and that small risk may be only 4% or 2%, that there could be a default by the counterparty, but that will apply to whatever assets I have. So there is a small amount of risk. That risk may not be is not zero, but then that also limits the amount I can get exposed to as a counterparty, because as a bank, you have to necessarily do this. However, as an individual, you don't care, right? You just have to for you, it's 0 or 1. If he defaults, it's 0. If it does not default, it's 1. So it's all black and white for you. So you don't have to kind of do this. Now, we haven't seen a counterparty clearing corporation like the stock exchange go bust. We have seen settlement failures at a number of regional exchanges, and they've been bailed out sometimes. Sometimes brokers have lost money and so on. So this thing has happened earlier, but I still feel that the clearing corporations seem to be a lot more safe. The issue that we really have right now is that the buffer is not only at the clearing corporation, but because brokers take money from in advance from you before you trade, and you may choose to not trade today, but they still have the money. That risk essentially lies at the broker end.
Well, that brings me to their other innovation, right? Or the other thing that SEBI was talking about, which was that they don't want you now to directly give money to the broker. They're saying you can directly just pay rather than have the broker as an intermediate account. You can directly just pay the clearing corporation, I guess, or block the money, and it'll be in your own account. So that changes the nature of things, right? I mean,
it does. They did this for the other side, which is the shares. So earlier, what used to happen was your shares were never held by you; they were held in a common big pool account held by the broker, right? This was commingling. All the shares were held at the same point, and the broker held all the shares and just delineated, saying, you know what, I have 100 shares, 10 shares belong to Shray, 20 to Deepak, and so on. Now, the SEBI, in its wisdom, a long time back, said, listen, we can't have this. Can we please segregate the ownership and not leave it at the broker level? Can we create individual demat accounts for every individual? And that demat account is where the shares should be. So even though a broker may have a centralized pool demat account, they have to necessarily transfer whatever comes into their pool demat account into individual customer demat accounts, which is why we also, as a PMS, we may have a pool demat account to be able to trade, but when we receive those shares, our custodian will instantly move them to the customer demat account on the same day. So at the end of the day, the number of shares lying in that demat account in the pool demat account has to be 0. And we have checks for it. So brokers have to have similar checks where they say the pool account should have nothing, because the clearing corporation actually pays the pool. The pool has to be then transferred by the broker to the individual customers. This happens without fail every day. And you can see the shares in your demat account. If you buy shares today, in today's date, because things have changed, we should T+2. So it's now T+1. So that means tomorrow evening. If you buy today morning, tomorrow evening, the shares should appear in your demat account. Fabulous. They haven't done this for cash. When you pay the broker cash, it goes into the broker's bank account. The broker does not have a different bank account for every customer. The broker has just one bank account. That is a commingled bank account for all your customers. What happens over here is something can be misused. I'll give you the example of what caused the broker misuse at the other end, where shares were pooled together. Brokerage, a fairly famous brokerage called Carvey, took this pool account where all these shares were kept. They said, this is pool account of my customers, but you know what? Why don't you guys give me a loan? So they went to Bajaj Finance, to HDFC Bank, to all of these places and said, can you guys give me a loan? So they took 1,000 crores, 2,000 crores, 3,000 crores as a loan against whatever the shares were in the pool account, even though the shares in the pool account didn't belong to them. The financial institutions too, because it was established practice, gave them the loan, saying, listen, worst case, if something goes wrong, I'll just take the shares from the account and sell them. It is when Carvey went down that these banks tried to get a hold of these shares. And the courts and SEBI said, you do not have access to these shares. I don't care if they were pledged to you, but these are not Carvey's shares to give out. So even in the end, after a court case, the court also ruled that these are not Karvi shares to have pledged in the first place, and therefore you don't get access to them, which is when SEBI tightened the screws and said, listen, you can't have shares in these pool accounts. Please move them to individual client accounts. And therefore, Karvi has no right to pledge them to a Bajaj Finance or an HDFC Bank in the first place. So we'll nip the problem right in the bud. What is to say the other side, where he may not borrow, a broker may not necessarily borrow from an account like this, but you can take the money and lend it out in certain ways. Now, remember that, this is a problem in many places. For instance, in wallets, when you put your money into a wallet, that money sits in a bank account. It's not the wallet provider. So, for instance, if you go to, a Google Pay. Google Pay is a UPI provider, but let's say a wallet like, MobiKwik or something like that. All of these guys, they're not banks. So there's an underlying bank in which all the float money will sit. The wallet balances will sit. That float money earns some interest because it is float money. So the underlying bank earns some interest or pays some interest on it. That amount is paid entirely to the wallet provider. RBI then says, listen, you can earn float money as a deposit amount, deposit interest from the bank. You cannot earn any money from taking that money out of that bank account and deploying it, in some arbitrage fund or some Bitcoin or whatever else. So you can't actually deploy the money somewhere else. So the RBI dictates how you can earn that money, and that can be earned by. There is no equivalent rule in brokerages. The brokers have the money, they have access to the money, and if you have not used them, they can do other stuff with them. Of course, there are audit limits. They don't necessarily have to follow it, but one way they can do things is that they can actually, lend it back to you. And we'll come to interesting ways that they can do that. Like I told you, in a payment gateway, the float that sits in the intermediate thing, they should be paying it to you every day, but because they pay to you on T+1, they lend it back to you overnight without having any money, without having to put any money of their own. And that, of course, now those rules have changed a little bit, but essentially, you don't have to get access to your own money one day earlier. You pay an interest and somebody makes money off of that interest, which is equivalent to float. A broker can do exactly the same thing. We'll come to that. But what is happening right now is SEBI saying that there is a new innovation that came from RBI recently. They said we can do UPI with a single mandate, multiple debit. This is great because earlier the idea was this. If I gave you a mandate saying you can debit up to 1,000 rupees from me, it was a single debit that I could debit 600 rupees, but once I debit the 600 rupees, the mandate is finished. I had to get any more money from you, I have to make you sign another mandate. I can electronically make you sign it, but it's a pain. So now, for instance, if I go in and I want to buy shares, and by the way, RBI has a retail direct platform for gilts. The way they do it over there is they ask you to transfer money in the morning. If you've bought any bonds with it, that's great. If you haven't bought any bonds with the money is transferred back to your account using UPI by the evening. So that means if 3:30 the market closes, by 6:30 or 7:30, the money is back in your bank account. So RBI doesn't earn any float on it. Nobody earns any float on this for the period of the day. The problem with the system is money still has to be transferred and then transferred back if it's not used. So RBI said, listen, for this, let's change the process by saying, if you want to trade for 100,000 rupees, block it in your bank account. If you trade for 10,000 rupees today, I'll take out 10,000. But the mandate continues. It's a single mandate, multiple debit. So tomorrow you can trade for 20,000 rupees and I'll take out a 20,000. The mandate has now fallen to 70,000 rupees remaining. So why this was created perhaps was for the retail guild platform itself to not move money back and forth when people are not trading. It can now be used by stock markets, by SEBI saying, why are you storing money with the brokers in the first place? Why not simply say, let us not have the brokers store any money with themselves. It's not required. They don't need any money. Why don't we just transition to a platform where you say, to give a single mandate, let the money stay in your account. And the same way that the depository system exists, the depository system is separate from the brokers and is separate from, the brokers do not have control on your shares once they're in the, of course, they have control in the sense they can debit them when they want, but they can't pledge them and take loans against it and so on. They may have access to your bank accounts in terms of having a mandate to debit it, but they can only debit it when you made a trade. So the money stays with you, float on that money stays with you. Think of the equivalent of saying, if I pledged my shares to the broker, I would have to transfer the shares to him. The dividend on those shares would come to the broker, because according to the company, the broker is the owner because it's sitting in the broker's demat account. Then the broker would have to say, listen, I got 100 rupees of dividend from these shares, and Deepak owns 30 shares, so I should transfer 30 rupees to Deepak. Shray owns 40 shares, I should transfer 40 rupees to Shray, and so on. So broker has to make all these considerations. Now what happens when you pledge shares? They stay in your account with a pledged mark to the broker. You still receive all the dividends in your account because you are the eventual owner of these shares. And if you cannot honor your commitments, then the pledge allows the broker to transfer the shares to himself in lieu of whatever he's owed. So I would say the same thing applies now to cash. Instead of taking the cash on their behalf and earning the interest in their account and keeping it for themselves, the money stays in your account and earns interest for you as maybe. And then when the broker says, listen, you've traded for X amount of rupees, I will take only that X amount of rupees out of your system. It's a very interesting way to switch from broker ledgers to no broker ledgers.
My first question, you'd hinted at the number at the start of the podcast, talking about how there's a fairly large amount of money that's always floating around, and you'd hinted like the number could be north of 20 to 30,000 crores. So here's my first question, based on what you've just said. If this actually does happen, what does it mean for brokers? How big a deal is this for the brokerage industry?
Oh, yeah. So, this is actually where it gets very interesting. And perhaps one of the things that we have to understand is, how do brokers currently deal with cash? Right? So, currently, brokers have money in their own accounts, right? So if you've given I have given 100,000 rupees, you have given 200,000. My 100,000 allows the broker to let me trade up to 100,000 rupees worth of something, and for you 200 rupees worth of something. But what is this something? This something is, let us say, forget the F&O system. Let's just look at the stock market system. There are many types of trades that can happen. One, I want to buy a share that I want to own. I want it transferred to my demat account at the end of the day, and therefore I want to own it. So if I want to buy 100,000 rupees worth of shares, I should have 100,000 rupees of cash in my broker ledger in the beginning of the day. Otherwise, I can't trade it, right? So the broker requires me to put the full margin right there. The second is, I may have shares that I actually own. Now, if I have a DP account, a depository account with the broker knows how many shares of which company I own. So if I own 100 shares of Reliance and I want to sell 100 shares of Reliance, the minute I place the sell order, they can say, listen, you have 100 shares of Reliance, that's why I'm allowing you to sell them. But you can't sell 200 shares of Reliance because you don't have them in your demat account. So you can sell what you own. Again, no problem. If I want to buy or sell shares that I don't own, like I told you about liquidity providers, jobbers, anybody can be one. Now, this gets interesting because with my 100,000 rupees, I can buy shares for what is called intraday. I don't want to own them. I want to square off the trade at the end of the day. So a broker may say, listen, you can buy 100,000 rupees worth of shares and sell them by the end of the day. You have 100,000 rupees, I'll allow you to do that. This is great, but this is not exciting enough for a lot of traders. So they say, listen, I'm squaring it off by the end of the day. Why are you limiting me to how much cash I have? So what exchanges do is say, listen, we don't care if you want to trade 100,000 rupees or 500,000 rupees, but we'll give you a certain limit. That limit is, let us say, 20. I'll give you 4x, 4 times what you provide as margin. Now, I can say, listen, I'll give you 100,000 rupees. Allow me to buy 400,000 rupees worth of shares, and I'll sell them by the end of the day. Or sell 400,000 rupees worth of shares and I'll buy them back by the end of the day. So you don't have to settle it in any way. So now you're thinking, well, you know what? Max, this guy can lose his 25% in the day. So I'll allow him to do this with a 4x leverage. Now, I might ask you another question. Why do I need to give you cash? Why can't I give you, a fixed deposit that is pledged to you, a liquid fund that, so you're thinking, okay, you know what? If he defaults, that means if he loses 25%, I can invoke the pledge, which is take the liquid fund and sell it in the market and receive the proceeds, or I can just simply sell the shares that he's pledged to me and this thing, or take a fixed deposit and pledge it out. So typically a broker, and now the exchanges themselves require it, say, listen, you can do this intraday trade with 50% cash margins. 50% cash is either cash or a fixed deposit or liquid fund, something that is equal to cash, that does not have ups and downs. Or I can give 50% of my margin. So instead of 1 lakh rupees as cash, I give 50,000 as a fixed deposit pledged to the broker or the counterparty, that's the clearing corporation, and 50,000 rupees worth of shares. Now, shares have something called a haircut. So you actually have to give maybe 75, 80, 90,000 rupees worth of shares to be able to get a 50,000 limit. They won't give you the limit on the full amount of shares. But if I do that, then I can do this intraday trading for as many days as I want. The only thing that the brokers require is, listen, if you did this intraday trade, you bought, Reliance at 2,500 rupees. But before the end of the day, Reliance dropped to 2,450. So you lost 50 rupees per share. You bought 100 shares and sold 100 shares. So 50 rupees per share into 100 shares is 5,000 rupees. Those 5,000 rupees is what you have to pay to the exchange as cash at the end of the day. I can take margins, fixed deposits, all of that, but this 5,000 loss you have to pay me. If you make a 5,000 profit, I'll pay you. So the exchange will pay me and I'll pay you by the end of the day. This is great because this works for liquidity and works for all of that stuff. This is fantastic. But now, when I switch over into the F&O part of the game, which is the bigger part of the game, because F&O is like 200, 300,000 crores a day, where stocks are only about 30, 40,000 crores a day. Now, if you are buying an option, you need full cash. That means if I buy an option for 10,000 rupees, I need to put 10,000 rupees as cash. And this can't be a fixed deposit or anything. That just has to be actual cash. The second part is if I sell options. If I sell options, to sell an option worth, 10 lakhs, that's the exposure. I might receive 10,000 rupees as a premium. But when I sell an option, I actually have to have 100,000 to 150,000 rupees as margin. Again, margin is this 50% cash, 50% stock kind of. So 50% fixed deposit, 50%. So I receive 10,000 rupees of cash, but I also have to have this 150,000 rupees as margin sitting with the exchange. Now you're thinking, okay, brokers do all of this. How can they not have cash available to them? My answer is, here's the deal. Whatever cash you need, which is to pay for this F&O, like buying options, or if you're doing futures, the mark-to-market exposure and all of that, this is the actual cash requirement. Please place a block, which is like amount supported by a block in your UPI block in your bank account. Block out that much. Anyway, for margins, you're giving liquid funds or fixed deposits or securities. Please go and give that as well. And that's a separate thing. That does not require the broker to own any cash. So for the cash component of your trades, you're giving a block in your bank account. For the margin component, you're giving securities or fixed deposits that are separate. Why does the broker ever need to have cash? So what happens now is, every time the broker needs cash from you, end of day, you have bought some shares, you need to pay for them. End of day, you have bought options, you need to pay for them, and so on. You end up with this situation where the broker says, listen, at the end of the day, you owe me so much, I have blocked so much more. I'll just take out whatever I need. And the next day, something is left. So if I have blocked 50,000 and you've done an option trade of 6,000, I take out 6,000. I know now that the block remaining with you is 44,000 rupees. That 44,000 is available for the next day to be able to trade. Now, what this happens is it allows you as a customer, Shray, to earn that overnight float on the 44,000. So if even the 50,000 was there yesterday, today it's 44,000. Tonight, your bank will pay you your savings bank interest of, of 3.5 or 4% on that entire 44,000. Secondly, the broker doesn't have the cash. This is interesting because since the broker used to have the cash, it was possible, very unlikely though, but possible, that you had given 50,000 to the broker, I had given 150,000. I traded for some reason for 160,000. And the broker used 10,000 of your money to pay. and told me, Deepak, I have used somebody else's money, but please pay.
Tomorrow pay.
Yeah. So this commingling risk is where the issue is, because you've lost the 10,000 for no fault of yours, right? So in a way, it could happen. I mean, earlier it used to happen more openly. Now they have blocks on it, but it's still a little invisible to every individual this thing. So now they have some rules around their penalties around when you don't have the money and so on. But technically, some of this can happen because you may not even have traded that amount. You might just think there's 50,000 remain in my ledger, but if that ledger got used and tomorrow that it got refunded, there's not any way for you to know because it won't reflect in any of your statements. Now, what happens over here is when it reduces the commingling risk, one thing that it definitely has done is, you used to have money with the broker. I used to have money with the broker. Maybe I'm a big trader and you're a little trader and you don't trade too much. Whatever money you had with the broker continued to earn float from it. Maybe they converted it to a fixed deposit, gave it to the exchange. They earned float on that exchange. You earn only 3.5% on that money because it's in the savings bank interest. But the broker could have been earning 7 or 8% out of it. Now, the amount brokers earn on just this is roughly 20 to 30% of their overall income. That means if they make 1,000 crores in income, 200 to 300 crores comes somehow or the other from this float income, which is quite huge, you can imagine. Now, when you tell a person you can no longer own cash, you can't earn, you basically crippled the broker to the extent of 20 to 30% of their income, which means a very profitable business suddenly lost 20 to 30% of their top line. And that top line costs nothing, right? In the sense of whatever the broker does, he has to continue to do anyways. He has to have a workforce and he has to have an office, and so the expenses remain the same. Your revenues come down by 30%. What's going to happen to your profits? Your profits are going to collapse substantially more. So this is actually quite a big difference now, but it is for reducing commingling risk and for keeping float income earned by the actual person whose money it is. It's a good thing.
In this case, basically, the broker actually never gets money other than the fees you actually have to just pay the broker as their fees. The broker is almost now just it transmits information. It doesn't actually transmit money. Is that correct? I mean, it just connects you in a sense to a clearing corporation. Just is my understanding correct?
Yes. In fact, earlier the problem with the thing that brokers used to do was say that, listen, we will actually find a counterparty. You need to sell 100 shares. Don't worry. Give it to me. I will find someone who wants to buy 400 shares or 100 shares, and therefore I am the broker. You need to pay me a commission. Now, it no longer happens that way. The broker is just the guy who has the license. You go there and say, I want to sell 100 shares. The broker doesn't go and find anybody. It's on the exchange. Somebody else, because of the exchange's popularity, comes and says, listen, somebody wants to sell 100 shares of this at this price. I'm willing to buy it. So I will place the buy at the same price, and boom, the trade happens. Broker doesn't actually do this finding of a counterparty anymore. They're just the people in the middle who are helping facilitate the trade. What risk are they taking? They're taking the risk that you don't pay up. But you know what? They're taking all your money in advance. So where's the risk that you don't pay up? They're taking the risk that, the person on the other side may not deliver. But again, that risk is not in the broker side anymore. Its risk is entirely sitting with the counterparty, which is the clearing corporation. If the clearing corporation sees the other side doesn't pay up, it will go to the other side's broker. If the other side broker goes bust, it will use the corpus that it has to pay. So your guaranteed payment by the counterparties, the broker isn't taking that risk anymore. So therefore, I think having this excess float income is a side effect. It was never there earlier. It suddenly become a side effect of collecting the money in advance and having that money for their use for a meaningful amount of time. It was never a large line item for brokers before 2000. It's only after the new age brokers that have come in that have started collecting money in advance that, float income has become meaningful. And now you're right. They've gone back to being intermediaries without necessarily having the same, let us say, responsibilities as they earlier did of finding counterparties, right? So I think the float income that brokers made was almost accidental and in a way providential. So therefore, it should not be surprising that it goes away.
So here's, you had started giving me some numbers. Can you talk a bit more on how much does this actually hurt brokers?
Okay, so this is actually, quite meaningful in terms of, how the brokers actually structure this float money. They might take all of your money, put it into an FD and earn some float out of it. Simple way to do things. The other way, like I said, so let's say you're a person who says, I want to buy shares, but I don't have any money. The broker can, by the way, fund you. It's called margin funding. In margin funding, they can say, listen, you have 100 shares. Why don't I take those 100 shares and against those 100 shares, give you money as a loan. That loan can be at 18%. Oh, you say, great, fantastic. What do I have to do? You say, no, don't worry. I'll get you that money from somewhere. And but there's a rule. You can't take the money out. You have to use it to trade on shares in the broker itself. So in the sense, the money can't be used to take out and pay for a coffee. You can, but you can buy more shares with it. How do they do that? The idea is very simple. The brokers, of course, got his own. Let's say a large broker like Angel or something like that has 1,000 crore, 2,000 crore balance sheet. They can use that balance sheet, that's the 2,000 crore balance sheet, and lend up to 2,000 crores to their customers. So a Zerodha has a 4,000 crore balance sheet. Zerodha can lend 4,000 crores if they want it to their customers and so on. So the way margin trading works is that since a broker can lend out up to their net worth, which is about 2,000 crores or 1,000 crores or whatever it is, they can do two things. One is they can go to the market through a bank and say, listen, I need to give Deepak, say, 100 crores for him to, he's giving me 200 crores worth of shares as a collateral, and I'm willing to back that up for you. So you give me 100 crores that I give to him and he will trade, and then he'll pay me interest every month and maybe return the money after 6 months and so on. This is interesting. However, why should the broker go to the bank at all? He can simply say, listen, I have so many customers here. They're not using their balances. I have the extra balance available with me. Why don't I give this, up to my net worth, this is 2,000 crores. Why don't I give this to make this available for someone to trade? And when they actually buy those shares, I'll pay it up. And then eventually when the money comes back, we will, I have the money available and I can always make this happen. Now this, it's tricky, but earlier brokers should do it in a more convoluted way. But the backing up of the margin trading funding can be another source of revenue, which is why some brokers don't have enough of a borrowing, but they have very large margin trading numbers. So they say margin based funding of 500 crores, but they've only borrowed from banks and from other institutions only 150 crores. How does that 350 crores kind of split make it? And that split is where, they're charging you 18%. So effectively, float is earning them 18% in some cases and only 7 or 8% in some cases. Let's say by an average, it's only 6 or 7%. This is huge. Now look at the numbers from, say, Angel One, which is a listed company. So as an example, they don't make it very easy to split up. Angel One earned around 350 crores from interest and lending. Now, their total profit after tax that Angel earned per year is 700 to 800 crores. Pre-tax about 1,000 crores, right? So 350 crores out of that pre-tax profit of 1,000 crores has just come from this floatish kind of redeployment. And effectively, let us say that 350 crores was coming from the float money it had. And it has roughly, I think, last I checked, for Angel itself, the float assets are close to 5,000 crores. So there is a very large amount of 5,000 amount available. For 5,000 crores, if you're earning 350 crores, that's a 7% float asset income, effectively, right? So effectively, you're talking of 30% to 35% of your pre-tax income coming in from float income per se. And if tomorrow it has to increase its margin, it does not have access to any money of the customers, it will have to go and borrow that money from the market. So instead of earning 7%, it may end up earning only, say, 3%. Just to give an example. And then that will halve the margin trading income that it earns. But apart from that, there was float income that it earned from FDs of customers who have given it money but not deployed it for whatever reason. That money is also earning them float income on a regular basis. And that float income itself could be of the order of, say, 100 or 200 crores. That again, so now what will happen is your profit from 1,000 crores per year comes down to maybe 700 crores or 600 crores. You have a 30% knock on your income just like that. It is huge. And this is, it also makes the lending business a lot less profitable. When I say a lot less profitable, earlier you used to earn 18% or 15% margins. Now you'll earn maybe 7 or 8% margins. So which is substantially lower, and it reduces your balance sheet. Now what happens is, let us say Angel One has I told you 5,000 crores worth of float assets. This sits on Angel One's balance sheet. So when Angel One goes to a bank and says, I want to borrow money, the bank looks at the balance sheet and says, listen, you have 5,000 crores of assets and 5,000 crores of liabilities. You have a huge balance sheet. It actually has more than 5,000, maybe about 7,000 crores. But if you take out the entire float income, all the cash that it has sitting with it, it has only 2,000 crores. So it reduces the ability for Angel to borrow if this rule actually came about. And therefore, if actually Angel One's balance sheet is 10,000 crores, half of it is float. So if it could borrow X today based on its balance sheet size, it can only borrow X by 2 tomorrow because of its balance sheet size. If you look at just the balance sheet itself. Another example here is ICICI Securities. Now, ICICI Securities typically has customers who have an account with ICICI Bank. So they don't actually earn much of the float income. They only earn from margin trading. These are, accounts are 3:1 accounts and so on. But they earn 500 crores from float and funding. This could be because when people sell options, they place margins with the exchange, they take money from their accounts and place it and so on. This is also a fairly huge amount. But if you look at the 500 crores that they earn, this is roughly half their net profit of 1,200 crores. It's a meaningful hit if that float income were to be hit in any way whatsoever, right? The largest broker in the country, which is Zerodha, it has up to, I think, 18,000-20,000 crores because it's one of the largest. It deserves to have so much money sitting with it, and
most active traders as well, right?
Most active traders as well, yes. So there are people who trade a lot and therefore keep a lot of money in their accounts. There's 18,000 crores probably in customer money as of 2022, and they have 2,000-3,000 crores of their own money as well. Now, if you take 7% of a 20,000 crore balance sheet, that's 1,400 crores in revenues that you may be receiving in float. I'm not saying that they do, but I'm just saying that this is the impact. For a company who makes 4,500 crores, now that is very big. It makes 4,500 crores in revenues. If you take 1,000 plus crores that's coming in from the float part of the universe, that is a significant change if they were no longer able to earn that float from 20,000 and they have to earn the float only from 2,000, which is their own money. Now, if brokers can't earn money out of float, what changes for them is their entire business model, which might have been based so much on, I will earn 30% from float, I will earn maybe 70% from the brokerage I charge and maybe some of the other charges and so on. And you know what? I'll make a 40% profit. So if I was earning 100 rupees and 30 rupees was coming from float, 70 rupees was coming from brokerage and other charges, and after my costs, I was earning 40 rupees as a profit. Very nice business. Take away 30 rupees, I'm making only 10 rupees as a profit because my costs remain the same, right? So you end up with a situation where a high float income based broker essentially now has extremely broken down margins to the extent that can convert a company from ridiculously profitable to just about profitable or sometimes even loss making in certain cases.
The obvious thing that comes to mind to me is then this will be compensated for an increase in brokerage charges. Does that sound intuitive to you as well?
It does because, in a way, if I have 30% of my income that comes from X, that means if I earn 70 rupees from everything else and 30 rupees from float, I might have to literally double my charges, my brokerage charges, because if I double them, I will lose a lot of income from people who say, listen, this is too much brokerage. I will not pay this. It's only some of the diehard people who will pay the double charge. And maybe 25-30% of my customers leave. If they leave, if I adjust for the leaving, I can still earn that same 100 rupees, but I'll have to double my brokerage and assume I lose 25% of my customers. Now, this is a big problem because one of the things that a broker might be saying is, listen, I'll increase the brokerage a little bit and hope that volumes make up for it. 15 years ago, we were trading 40,000 crores a day. January 2023, we're still trading 35, 40, 45,000 crores a day. End of January, that number has increased, but for a good part of January, we were trading 40, 45,000 crores a day in the market. So in 15 years, even if you say that, listen, let's compare weekdays to weekdays, the volumes have only increased by 50% from 2007 to 2023. That's 15 years. So that's not huge. It's not even GDP level growth for the economy. So I think volumes will go down if you increase brokerage rates. And okay, let's put things another way. This whole proposal that's come in in the sense that you can continue your old style, keeping the money with the broker if you want to. But if you want to, you can switch to this new style. This new style is UPI based. There are UPI limits. And if you have tens and tens of crores, how do you transfer them using UPI? We haven't addressed those problems. But I think given where we are going, this may initially be a proposal that says it's optional. In 2 or 3 years, they might just say, listen, it's mandatory.
So, Deepak, then two things come to mind. We look, brokerages have done great work, I think at least. I mean, brokerages like Zerodha and all have done great work in bringing in new investors and customers into the ecosystem. If now you're going to, as I said, while it may have been fortunate or an accident, a happy accident that they were able to make some decent amount of money off this float, it was not done with malintent, certainly. And so where I'm going with this is, if now as a consequence of this new SEBI rule, brokerage prices are going to go up because now they're more visible to customer, and the risks of defaults and all were so low anyway, do you think that this might potentially be a counterproductive act on behalf of SEBI?
It's actually true that, the risk was low, but, the risk is low basically because we don't remember a lot of the problem. You still have, for instance, there is a risk that brokers continue to bear. Customer, like I told you, that, if the futures and options margin double 3 times, customer doesn't have any money, brokers still have to deal with it.
Yes.
In the sense, the brokers have to make up the money, even though they don't have any cash anymore. So they can't pay from somebody else's cash, but you know what? They still have to bear it. It's a bigger load on their balance sheet. So in a way, they're justified in raising prices. However, what this has done is moved some of the default risk-bearing capabilities to the clearing corporation. Now, clearing corporation knows because when you when you block amount from your bank account, it's not the broker that's debiting it anymore. It's the clearing corporation. It's saying, listen, Deepak owes me. I don't know who Deepak is. He's coming through Zerodha, but Deepak owes me 35,000 rupees. I'm going to debit his account with 35,000 because the mandate is to the clearing corporation. This is still, a problem for the central corporation. The clearing corporation itself has to be very savvy because margins can change 3 or 4 times a day. Margins can go up. Losses can happen. Today, the brokers used to carry extra margin just in case, you default and so on. Now, some of that risk will have to be taken up by the clearing corporation that says, well, you know what, I only want 35,000, but you know what, the broker is saying Deepak needs to pay 55,000, so I'll block 55,000 in his back account and so on. So this idea over here is that the counterparty, which is your clearing corporation, has visibility on how much you have pledged and so on. The broker is now responsible if you default. So the broker also needs visibility into the margins. Some technology has to spread this around and say, listen, somehow I need to cut Deepak's trade because the amount he has blocked is too little to do this. And earlier, the broker knew he had the money. So he said, he's only given me so much money. His exposure is more than that. I'll cut his trade. Now it's like, oh, he has he has blocked in his account 75,000 rupees, but you know what, I'm seeing his trade and he's already down 80,000, so I need to cut his trade and tell the clearing corporation to take out whatever money is there. So this problem now exacerbates a little more. So they can be default risk. It is borne by brokers. There is more work for brokers in managing risk. The float income that was perhaps paying for some of this, and this kind of work was not existing earlier. Now there's new work, but no money for it, right? So effectively, the net impact is negative. And you're right, that brokers were not malicious in this intent. It was just a great way for them to earn money and keep brokerage costs very low, and therefore enhance volumes. The unfortunate problem is it has probably created a lot of over trading as well. People thinking brokerage is very slow or low, like Robinhood traders in the US. They came in, they traded their, like a gambling den that attracts customers for the entertainment more than for the earning capacity of a market. People come in, they trade, they lose, they feel happy that they just participated and go off, or they feel sad, then they want to earn the money back by revenge and so on. This is this is something that perhaps has been a side effect also of low brokerages. So one of the things that will happen when brokerages have to get more efficient and not earn the float money is they'll keep the prices of the brokerage relatively higher. So perhaps I say this, but I don't know if it's true, meaningfully more savvy or more deeper pocket customers come in who have the ability to understand that trading costs are high enough that I shouldn't overtrade and so on. However, the problem is not that brokers haven't defaulted. We've seen brokers default. The problem is the whole system gets undermined if there's a systemic risk. If there's a systemic risk of one large broker breaking down, and if you're a customer of that large broker and suddenly you're saying, dude, I had 5 lakh rupees with you. I didn't do anything wrong. Some other customers of yours went bust. So, why are you making me suffer? So, the minute I start asking that question, I start mistrusting the entire financial system, saying, why did they create a system where I'm exposed to some other person's stupidity just because the broker needs to be able to pay margins to an exchange on time and properly? By doing this other process, it may increase the amount of work I do every day, but it insulates me from any risk that any other customer could have caused the broker to go bust. So my money is relatively safe with me. And therefore, I think, given how rare this problem was, it now decreases the consequence that even if the rare event should happen, it does not create negative externalities to customers who otherwise should not have been. And we've learned this lesson in the share ownership of shares business, where we've said move them into individual demat accounts and don't allow commingling. Now you said move them into individual bank accounts and don't allow commingling of cash either. And I'll have to say this with a caveat because, as a PMS, we also commingle cash, but we don't have any access to float. The custodians will not allow us to earn any float. And if there is any float that had to be earned at all by maybe parking the money in overnight funds, it has to, by SEBI rules, necessarily be allocated only to customers. You cannot even take a paisa out of any float earning that happens in the middle. There is still a commingling risk that you have the money in a single bank account, but that bank account is managed by the custodian. That bank account you do not have, PMSs do not have access to. And the custodian will only allow you to pay as much as is there in those accounts, and your fund accounting will completely fail if you for any reason pay more from one customer's balance into another customer's balance. So because we have created systems, and all PMSs are required to now create systems that ensure that this kind of bank reconciliation happens on a daily basis. You cannot have any discrepancies at all. The commingling risk and reward, there's no reward, right? So there's no reward for trying to put money or lending money to customers. You can't lend money to customers. PMS monies and securities cannot even be pledged. So there is no possibility of earning any float. So there's no incentive to try and game the system in any meaningful way at all. And it's completely zero. So over there, you've taken out the incentive completely. Here you say, well, you know what? Apart from taking out the incentive, I am actually going to refuse to allow the broker, because instead of telling the broker you can't touch this money, you're simply saying you don't have access to this money. So that's how we're doing this.
I'd like to end with a very big, quicker question. You have often been very impressed, if I may use that word, by SEBI per se, in this sense, and many regulators in India. I mean, you've talked about how RBI has helped move us forward, and UPI is amazing. And when we had talked about SEBI in the past, you were very happy at how we've systematically brought down leverage in the system. We have a more transparent system. Do you feel these new moves will make the ecosystem fairer, more transparent, and so on, and friendlier for investors as well? Will we continue to at least say maintain our edge over maybe the SEC, if I can call it that?
Oh yeah, I mean, I would say in the difference between the SEC and us is the SEC has far more powers of punishment than SEBI does. So SEBI does a lot of its rules with the thing that says, listen, I don't have the power to send you to jail, so I am going to make barriers that do not allow you to do bad things in the first place. So it's like saying I'll ban guns rather than allow guns but ban jail you for killing people. So the difference is that the enforcement process for a crime is much slower in India than the actual banning or not allowing of certain things. So that's why SEBI goes more into this, I will not allow this thing to happen in the first place. And I think a lot of the processes are well thought through. Here also, there are a lot of well thought through individual elements of this entire process. However, some of these things will have a lot of resistance from the industry and can take 4 or 5 years before they see reality. So while this is currently a discussion paper, they have not yet made it a rule. Then when it becomes a rule, I'm sure a lot of customers will complain, both individual investors and jobbers and traders, saying, why are you making us do UPI mandates over and over again? Oh, my UPI fellow says maximum 25 lakhs, but I want to trade 28 lakhs. All of these things will come into the play. SEBI will probably call them up and say, I'll listen to them and say, listen, I understand. So you know what? For people who want to do more than 25 lakhs, let's go back to the old system, but less than 25 lakhs, let's keep the new system. It will go to RBI. RBI will say, come on, this 25 lakh limit is nonsense. Let's bump it up, at least for the SEBI registered brokerages and the clearing corporation, to say 100 crores.
Which is everyone.
Which is pretty much 99% of the ecosystem. And anybody above that can do other forms of payment. So you're suddenly changing, you'll have to change the system along with changing the rules in order to bring to effect the simple concept that commingling is a bad idea. In the US, commingling is rife. Not only, they have very low interest rates. So there's not that much they earn in terms of interest rates, interest float. But whatever they do, for instance, in the US, the mutual funds earn float. In India, you can't, for instance. If a mutual fund owns shares, it can lend it out and lend those shares out in the market. If a person pays a certain interest rate on it, so let's say, for instance, they lent out shares of, Tesla to a short seller who wants to short sell them. The short seller pays a margin fee of, say, $0.50, 50 cents per share, and takes, let's say, 100,000 shares. That $50,000 is the income of the mutual fund, not of the unit holders of that mutual fund. It is of the mutual fund AMC itself. This kind of float income on shares is not allowed for Indian mutual funds. Indian mutual funds, if they earn such income, that income belongs to the unit holders itself. Brokerages was the only case where you could have the float earned by the brokerage, but not passed on to the individual shareholders. So instead of making them do this and pass that income onwards, SEBI has simply said, you don't need access to that money. Keep the money in individual bank accounts and do it another way. I think it's a noble thought process that says, well, we'll de-risk. And it is not even coming from out of the blue. We have seen defaults. We have seen people suffer. If a broker goes bust, it can take 2 years for you to recover the money, because you have to go through a process of arbitration. Then sometimes SEBI will tell the exchange to say, create a web page where people can apply. I have helped a friend apply for this. They have said, listen, give me your last known brokerage statement. He has sent the brokerage statement. They said, okay, you know what? You had 75,000 rupees, but here's 35. That's all we can give you, because that's how much settlement rules allow us to pay you. So he's got 35,000. Now he's like wondering, what do I do with the remaining 40? Should I fight it? Should I hire a lawyer? Hiring a lawyer will cost me 25,000 rupees. Why should I bother? It's only 40,000 and I'm paying out 25,000 plus God knows how many hearings in courts before I can receive the money. All these thought processes are unnecessary in the first place. Introduce an externality in the system that is entirely unnecessary. So SEBI is doing the right thing, but in the process will cause a lot of inconvenience. It will appear inconvenient to almost everybody until it is the most convenient thing in the whole world. It's like saying, the first time you saw UPI, the bank made you register and get a UPI ID and do KYC and all sorts of things. And you thought that's a pain. Suddenly, 5 years later, everybody's using UPI. You're going to a vendor and saying, click on scan some QR code, and suddenly 20 rupees you've paid, and he's happy, you're happy, nobody's paid any fees, and the need for you to carry cash is zero. That is when SEBI's process over here will sound like, oh my God, this is a scale higher than any other country in the world. But till then, and I'm sorry to say this, but it will sound painful, we will be blaming SEBI for a while. But I think this is a very radical move. And I think other people in other countries should also follow it, simply because of how powerful it is in reducing commingling risk.
On that note, thanks so much, Deepak.
Thanks, Shray. It was great.
Well, thanks for listening. If you'd like to listen to more of our episodes, do visit capitalmind.in/podcast. And if you have ideas or feedback, send them over to podcast@capitalmind.in. See you next time.